For those of you who don't know Cambridge Associates, it's an investment advisory firm currently managing and advising about 400 billion in assets. It's mostly endowments and foundations that we advise, but we also advise institutional family offices, pensions, sovereign wealth funds, and so on. The firm started out in the 70s as a project for the Harvard University Endowment, and later on it developed into a full advisory service for institutions with regards to asset allocation, manager selection. And the final thing I want to say about Cambridge is that I think it's well known for its expertise in alternative assets. One of the first firms to invest back in the late 70s, early 80s in venture capital, hedge funds, and so on. Now, I've been at Cambridge for 10 years, over 10 years, and I've taken on multiple roles. So I've worked across different offices. I started in Boston, moved to London, came back to the States. I'm based in DC now. And I've worked across practices. I've worked on client-facing roles, research roles, hedge funds, venture, you name it. So that's my brief background.
Well, one of the things that we sent out to the whole audience ahead of time was some homework. And one of the pieces of homework that we sent them was your report that Cambridge has published a few months ago. And so I'd love to talk a little bit more about that report. Can you tell us more about the process of the research that you did that went into that report? What drove you to write that report?
Absolutely. So it's not just me, by the way. Mike Armstrong, sitting over there, was key to this effort, as well as Alex Devnew, who on the operations side. So it was the three of us that ventured into the unknown. It was scrappy. I would call it non-institutional. Scrappy, like hustling. We were reading Medium articles, calling people. I would call it more like investigative reporting in a way, but with a difference that investigative reporting, you're looking for the information. Here, the information is all out there. It's an open source movement after all. The problem is that it's a lot of information and it's difficult to digest, so you need to ask a lot of people how to put the pieces together. So it took us about 5 to 6 months, I would say, of bothering people like yourself, multiple calls, and reading, and then I think we were at a level where we could understand what's going on in the space, and from there kind of we took off. So it was a non-standard research process.
Got it. And I mean, this is well outside the normal field for a lot of institutions to take a look at, right? So what drove you to be interested in this topic in the first place? What attracted you to this industry?
Yeah. So I think I can answer this in two ways. I mean, there's what drove Cambridge, right, which is probably the most interesting part for people, and then what drove me specifically to want to do this within Cambridge. So what drove Cambridge? The two things mainly. So the first is that in a lot of the venture capital funds, well, I wouldn't say a lot, in a handful of the venture capital funds we work with and invest our clients' money. In 2016, 17, we were seeing a number of crypto deals, even Bitcoin in some cases. And therefore, clearly something was going on. So we needed to be aware of what's going on. The second is that in the 2017 bubble, a lot of clients started at least inquiring at that point about what on earth is going on, what's happening. So given these two reasons, we had to take a deeper dive. We had to form an opinion. It was our job to do so. So in early 2018, Mike and I started coordinating this effort. And the coordination was because it's a space that doesn't fall between, in any certain area, we had to coordinate resources from the venture research group and hedge fund research group in some cases, operations group in some cases. to build up our knowledge there. Now, what drove me personally, I'm Greek, so I'll leave it at that. No, anyway, I'm just kidding. Jokes aside, I'm Greek, and Greece went through a 10-year Great Depression where the GDP contracted by about 25%. I've got real close friends that lost everything. So the idea that a catastrophic scenario could happen did happen. And I think anybody who's lived through a scenario like this cannot just dismiss Bitcoin. In fact, Bitcoin itself was a pretty intriguing idea. What I suggest people read if they haven't already, there's a great piece that Wences Casares wrote. I'm sure you have. The Case for a Small Allocation to Bitcoin. It's a must-read in my opinion. It's extremely well written. And in the final paragraph of this letter, he talks about his family in Argentina and how they lost their shirts like numerous times, and how had they had Bitcoin, they could have saved a lot of their fortune. So with that context in mind, I read a book called Mastering Bitcoin by, guess who, another Greek, Andreas Antonopoulos, which again is one of the best things I've read in the space. And it can get a bit technical, but it was very helpful in understanding that all of a sudden we have a new method, a new way, in a sense, of creating digital scarcity. And that means digital scarcity outside of walled gardens, outside of centralized companies, so true digital scarcity. And when I realized that there's a new system that's able to do that, I thought it was a transformational idea, at the very least. Because, why was it a transformational idea? Because what moves the economy in general, I mean, there are multiple forces that move the economy, but there are two main forces, right? One is information, and the other are assets, value. So in the case of the internet, we had the information revolution, where it changed the way information was transmitted and gathered and so on. And now all of a sudden we were able to create internet native digital assets through the use of this technology, therefore a new tool in our toolkit. That's the way I view it. And what would that tool do? I mean, that's what you guys do. There's a lot of things that are in progress and could, we don't know exactly how these things will end up, but in my view, it was an extremely powerful tool. And I said, I really want to take a deep dive here. And I raised my hand and I said that I really want to coordinate this effort. And from there, we continued. January 2018, we started it.
Yeah, there's so many people who have similar personal stories of, they've witnessed some of the issues caused by the current financial system. And so they're looking at alternatives, trying to understand, could something be better? So, we talk with people like that all the time, especially the entrepreneurs in the space. We see a lot of people who have had very similar experiences to what you're describing. That being said, there's a lot of people who have not had those types of experiences.
Sure.
And, typically at big institutions, the committees that end up making some of these decisions, may not necessarily have those types of experiences.
Yeah.
And so I guess my next question for you is, did you face any sort of pushback as you were doing research here?
Yeah.
When you're talking to your clients and, you find a champion within that firm that's really interested in crypto, what kind of pushback do they face? We have a number of people in the audience here who work at major institutions that believe in crypto, but they maybe are having a little bit of difficulty getting everyone else on board. So if you could talk a little bit about your experience there,
of course,
both within Cambridge as well as with some of your clients, I think that would be really valuable.
Absolutely. So I'm going to start by saying that we've been lucky with Mike, Alex, and other folks interested in crypto, because Cambridge generally encourages, it's an organization, it's a big organization, but it still encourages, as it did in its early days, working across silos. So we had full support from management in our efforts, right? So that made our life really much easier, and I think, than the average organization. And because we could work across silos, coordinate resources, and get things done. Now, what, in my opinion, there are three. I'll start with the three main reasons I think it's very hard to get crypto through a large organization. And then I'll attempt to give some advice. It's a case-by-case basis. I'd classify these three reasons as, silos that just mentioned, time constraints, and I'll get into each one of these in more detail, which is probably the most important one. And three, I would say agency problems. So what does all this mean? With silos, very simply, most of these organizations are split into different groups, right? Take the research group of an institution. In many cases, you have the hedge fund guys working on underwriting hedge funds and managing the carve out in a way the piece of the portfolio that involves hedge funds. You have the venture guys on the other side. When a thing like crypto comes in, it doesn't fit neatly anywhere, as you know. So I've heard numerous times venture folks say, this is not venture. There's mark to market, all of that stuff. I mean, it's not venture. It's hedge funds. Then you go to the hedge fund guys and they're like, these are not hedge funds. This is venture most likely. So, falls between the cracks. Somebody needs to pick it up and coordinate resources. In many organizations, that's difficult. Time constraints. In my view, it's the most important, most difficult hurdle. Think about it. In organizations that are run at least efficiently, people don't have much time. They have their current jobs. They have 10, 12 hours during the day. They are evaluated on their current jobs. They're compensated on their current jobs. So why would they drop what they're doing to start, a labor-intensive process of looking at a space that they weren't asked to look at? And if they really want to do it, they could also take time away, over the weekends, and then their family gets upset and so on. So time constraints are pretty strong. And finally, agency problems. Let's assume you've decided to do all this work. The next step is you need to in any large organization with numerous layers of reporting, you need to convince numerous people that it's a worthwhile endeavor. Numerous decision makers with different agendas and different levels of knowledge. So that can be really hard. So my advice is, my advice first of all is if you don't believe in the potential of crypto, there's no point doing it. And the only way people are going to listen to you, if you truly believe in the potential of crypto, that's the only way people are going to listen. The other thing that I've thought about quite a lot is that, and to put it in a corporate context, language, I think doing the work on crypto, in my opinion, is like doing R&D. It's like being in a corporation doing R&D. It's research and development. What is research and development? Research and development is work being done for a potential long-term valuable call option, right? That's what research and development is. Now, sometimes it works, sometimes it doesn't. Of course, corporations that don't do R&D, or entities that don't do R&D because it's a cost burden, at least in the short term, lose out in the long term, and that's a fact. So if you tell people that this is an important R&D effort, then it turns from a drain on resources to something worthwhile doing. So I think positioning as R&D is kind of a strong way to do that. I mean, these are my 2 cents here. It's different dynamics in organizations and, case-by-case basis.
Of course, yeah. that's a really interesting framing, especially for investment organizations that typically don't engage in research and development, and they do have these kind of established silos, and they operate how they have been operating in the past.
That's right. But R&D is crucial because things evolve.
Yep.
And you need to be looking at the new areas that are coming and be in the front line if you want to add value over the long term. And I'm not saying it's crypto necessarily. That's a separate argument. But I believe that it could very well be crypto. That's one of these long-term valuable call options.
Of course, yeah. The part where you're talking about silos really resonates with me, because we've had that experience of, talking to the hedge fund team, and they're like, no, this is early stage technology investing. This should really live in the venture world. You go talk to the venture people, and they talk about, we don't mark to market. This is too volatile. This doesn't fit within what a venture investment for us typically looks like. All right. And so we'll spend the time, get people over the hump, get them educated. So in some of the cases with your clients where you've had this type of an experience, are there any attributes that the clients that have actually gotten over the hump and allocated to the asset class share? Is there something that they have in common that allowed them to overcome the organizational inertia and get there? Yeah,
so there have been cases of institutions that have started investing in the space. I mean, it all started with A16Z and Paradigm, as you know, but now there's a second round of checks, like in funds that are not A16Z and Paradigm. So there's definitely been a number of institutions that have been investing. I'll give you my perspective, which could be very different from somebody else's perspective, because I work with endowments and foundations for the most part. They generally see this space through a venture lens. They see it through a venture lens because, frankly, to understand it, you need to take a venture lens on a fundamental level. And so for the organizations that have gone through the process of deciding to research crypto further, it's usually a venture guy, a venture person that it has taken the lead on that. So venture is more interesting to institutions right now, but there are good reasons and bad reasons in my view for saying that you want to do venture. The main bad reason in my view is, from what I hear quite often, is we don't want the liquid stuff. We want just the equity. And I feel that is a completely, this is my personal opinion, it's a completely flawed way of looking at it. And in fact, you could be taking much more risk if you're investing in equity deals than you're taking in tokens, despite the mark to market. In addition to that, you need to be playing at this stage of this space, when we don't know where value will accrue, you need to play the whole spectrum. This is the bad reason, and there are a lot of folks that are doing it because of that, and I think they're just not far out into their research process. The good reasons are that venture structures allow for a long-term perspective. They allow for managers to have dry powder, to average into a space that's evolving rapidly and growing. It also gives them the ability to protect themselves from the redemptions, and that's extremely important. Sometimes I see in open-ended funds and in the hedge fund world, redemptions usually occur at the worst possible time, where you actually want to have money to invest. So in that sense, a venture structure has certain strong benefits. It also allows a manager to play between equity and tokens, depending on how the value evolves and so on. And then, the carry is at the end of when all is, so alignment of interests as well. So, I mean, that was a long answer, but the short answer is that it's mostly venture that institutions are looking at the moment, and through a venture lens.
Yeah, I share some of your misgivings there too, because I feel like there's a lot of people who look at investing in picks and shovels in this industry as being, like the safer bet. But in some of those cases, I feel like they have one foot in this old boat of how, the traditional venture industry works and how traditional investments work, and they want to put one foot into the next boat of this is what the crypto world could look like.
Yeah.
But having, one foot in separate boats can get really painful as the boats start to diverge.
Yeah, of course, of course.
And so, I think of it as you need to look at it from a first principles basis and understand that a lot of this industry is designed to have the value not accrue at the equity layer.
Absolutely.
Right.
In addition, the thing is that, if you mentioned infrastructure, if you invest in infrastructure, you're making an implicit bet on crypto assets.
Yes.
I mean, how are you going to make money on an exchange if you don't believe in crypto assets?
Exactly. You're getting market beta, but with illiquidity and additional idiosyncratic risk.
Right.
In a lot of cases.
Exactly.
You're speaking a little generally. So, to the recommendations from your report, right? You made some recommendations about some of your clients exploring allocation. What was the reaction like? Have you seen a lot of people reacting very positively and putting a lot of effort in? Have you seen a polarized kind of response where some people are like, no way, like never going to touch this, and other people are like, I love it?
Yeah. For the most part, it's been supportive, but the thing is that people that reach out to you usually reach out to you when they're in support. So I have maybe that limited data set, but I think we've gotten a lot of good feedback about it. I think it's probably polarizing for some that think that it's just not a space that's worthwhile. It's certainly not for institutions. But I think my opinion is that the report was very balanced, and it didn't make any exaggerated claims. It just said this is a very interesting space. It's worthwhile for certain investors that do their homework to maybe start making small allocations. So in that sense, it did catch the attention of numerous people, and at the very least, we've gotten a lot of questions, and we've gotten a lot of inquiries, and Mike and I have participated in numerous investment committee meetings where in some cases we talk, what is crypto? Why should we be interested in this? What is the kind of the fund landscape and so on? In terms of actual dollars invested as a result of the report, I can't quantify that, but I can say that institutional investment is still limited, but it's definitely miles ahead from like a year and a half ago. A year and a half ago when we started, there was nobody who was willing to make an allocation from the institutional world. It all changed with Andreessen Horowitz, but now we're seeing more and more institutions outside of kind of the Ivy Leagues making allocations, and also making allocations to managers that are not Andreessen Horowitz and Paradigm. So there's definitely been progress. It's coming in drops. It's not a flood. I think it will take time. And as the space also matures and de-risks, it's also going to keep increasing, obviously.
Yep.
So overall, I think it's been very positive. This is my perspective.
Yeah, that makes sense. So I want to change gears a little bit and focus on some of the recommendations you might be making to the clients who are interested in allocating, and how they should look at constructing their portfolios within crypto. Right? There was a quote in your report talking about how generalist VCs may not be the best way to get exposure to this asset class.
Sure.
Can we talk about that a little bit, and
Absolutely,
what led you to that conclusion?
It's one of the key topics, because in many occasions when somebody does get intrigued with crypto, an argument that often comes our way is, well, it's all great, but why should we be investing directly in these crypto funds and not let our generalist managers do the crypto investing for us? And I think that at this stage of this industry, my perspective, my view is that a dedicated crypto approach makes a lot of sense. That doesn't mean that a crypto approach can't work within a generalist fund, but there are many constraints. So, okay, what are the constraints? So first of all, you know better than me as a practitioner that it's extremely idiosyncratic. You have early liquidity, you have tokens, it's open source, token economics, mining, network participation. I mean, these things are just a different ball game from traditional equity investing. So it's a totally different ball game. And in the context of a generalist investment firm also, I guess it depends on the firm, but the common model is consensus-driven investment committee approach. So think about it. You're kind of the crypto guy in a generalist fund, and you go to the investment committee. Actually, one partner I spoke with told me it's kind of death by 1,000 cuts. People there some are knowledgeable, some others are not. They're definitely not spent the time on it. And you've got to make the decisions through that consensus process that is kind of outside the scope of crypto. So you have these constraints, and of course you have the LPA constraints, you have the LP constraints. I mean, a lot of LPs don't want the generalist managers to be doing too much in crypto. So you might say, okay, great, these are theoretical arguments, but what's the evidence? The evidence is that a lot of the people in these generalist firms that have been focused on crypto have spun out. I mean, we've seen numerous do that. And a lot of the generalist firms have actually opted to outsource the crypto effort to these same funds or even other funds. You have a lot of VC investors. So I think at this point in time, not investing you can invest in the generalist fund, that's great, but excluding the crypto native funds is a bad idea, in my opinion.
Yeah, I think you drew a comparison to biotech funds as well, right?
Yeah.
Where having the very deep focus on this one area is really critical because it's different. It's just so different from what general VC investing is like.
It's very different.
Yeah.
And somebody else was saying a couple of days ago that it's kind of like, I mean, it's not the same obviously, but it's kind of like life sciences and tech coexisting in one fund, which then that model kind of unraveled eventually. With crypto, it's even more of a different ball game, I feel, with the early liquidity and the mark-to-market and all of that stuff.
Yeah, I guess, in traditional investments, liquidity is typically a proxy for maturity.
Yeah.
And in crypto, that's not the case at all. And so
No.
it messes with everyone's existing mental models. Yeah. And so it becomes very difficult to think about, especially, in a more structured organization. And
absolutely. And when there are silos, it's even more difficult.
Yep. And so, as you're talking about crypto native funds and, how some of the managers are focused in that industry, the reality is people don't have a lot of track record, right? Yeah. The industry is brand new. A lot of the managers are brand new. So how do you think about that, right? Because typically, looking back at track record, past performance is not indicative of future results, and we all know that. Yeah. It's helpful to be able to look at some history, right? So how do you talk to your clients about that fact if they ask you about track records and how to select managers? Listen,
I'm going to start by saying this. Like, we all know crypto is a new space. It's a totally new space. I mean, it starts with Bitcoin in a long time ago, over a decade ago, but really it's a 2-year industry in my mind. If you expect a track record, you should probably be investing in more mature spaces by definition. So you can't have a track record here. You just can't.
Exist.
And so what do? I would make a parallelism here to what an early stage venture capitalist does, pre-seed, seed, pre-product market fit decision type of making. What do you have? You have the team, and you have the team's ideas, and you make a call. So I think there are many softer elements here in the decision making. I mean, we're looking for people that are passionate about this space, immersed into this space. That's very important. A lot of folks, kind of like yourselves, have published a lot of their thinking out there, and that's very helpful to evaluate kind of your thought process and your level of due diligence. So we assess that too. The other thing I would say is that in many cases, a lot of these guys have had at least an angel track record, and that's helpful. So we can go through their angel track record and their early investments in these companies and crypto assets, and kind of understand how also they're perceived in the community, how the entrepreneurs, think of them. Do they think highly of them? Do the various communities think highly of them? You put all these pieces together, and in my view, you should be. The best way to do this, because it's risky, is if you can, to invest in a handful of funds, not just one. And you hope that the odds are going to work for you. With a track record, a lot of people make decisions based on past track records, and that quite often doesn't work either. So, yeah, you can't have it both ways here. Yeah.
That makes sense. Yeah, and we've seen popularity of fund of funds, crypto-specific fund of funds, really pick up recently.
Yeah.
Due to the point that you're making, where as an allocator you may want to diversify a little bit.
That's right, and I think right now, because the check sizes are small, people are not going to put more than 0.5% or max 1% of their assets in. Even if you're a very large institution like $1 billion, it's hard for you to create yourself a diversified portfolio of 7 or 8 managers. You can, but the smaller you get, the harder it is. So yeah, it's one of these rare cases in these days where fund of funds approach makes sense.
Yeah. So I want to switch gears again and talk a little bit more about what's happened since you published your report. Right? I believe the report was published in February?
February of this year, yeah.
Right? And so we've had almost 10 months now of evolution. And so if you can tell us a little bit about the types of questions you were getting earlier this year, and then the types of questions you're getting now, I think that would be a really interesting topic to explore.
Yeah, no, absolutely. So first of all, there are many more people now asking about the actual managers in the space rather than what is crypto. I think we've gone past that period where we still have that, but it's already quite, an increasing number of people asking about, what is the fund landscape, rather than tell us about the, how the blockchain works and all that stuff. So that's one. I think the report, when it came out, it did increase inquiries, but I think the key moment, and you mentioned it before, was Libra. The reason, in my view, that Libra, whether it works or not, whether you like Facebook or not, that's a separate story. But the fact is that Libra is a project that the 6th largest corporation in the world is attempting. And somebody that reads that and sees that says, well, why are they doing it? Why are they using blockchain technology? Why are they using this methodology, this format? Well, the answer is maybe because it's an important technology, And since it may be an important technology, I better get my homework done. And also my clients are asking about it now that, they see it on TV. So I think with developments like Libra, with the recent situation in China, I think these are all very positive for institutional investors to really get up to speed and fast. Other things that have changed is, I think I mentioned it before, we've had the second round of checks into funds. Yeah. Before it was Ivy Leagues, like for the most part, and it was Andreessen paradigm, Sequoia, Andreessen, That's it. Now we've seen a second round of checks in other crypto funds and from other institutions as well. And then on the fundamental front, you know better than me. I mean, there's been a number of developments there too. So a lot has changed to the point where I'm not going to promise this, but we're thinking, you know, we haven't started, but we're thinking of maybe posting like a short update on the February paper because so much has changed. Yeah. That it's due for an update.
Yeah, it really does feel like a new market regime from, you know, when you publish that report to now. And
yeah,
I would say the regulatory landscape seems to have significantly changed because we've started to see, you know, specific SEC enforcement actions.
Yeah.
And while they haven't yet laid out, you know, clear bright line guidance on what's allowed and what's not allowed, through who they are choosing to enforce against versus who they're, you know, saying is okay, they're giving informal guidance effectively on, you know, what type of behavior is acceptable.
Yeah.
Right. So we're seeing, you know, regulatory clarity emerge slowly. We're seeing governments start to embrace it, and then, you know, I can speak from our experience as well. As soon as Libra was announced, everyone wanted to know, you know, why is Facebook doing this? Why are they building this technology?
Yeah.
I feel like Kyle explained pretty well, you know, the motivations for Libra building on blockchain tech, as opposed to trying to build this through a more conventional technology stack, and just bringing that to light for everybody, I think, is probably the greatest service to the crypto space that you know, Facebook and Mark Zuckerberg have done.
100%. I think it was a key moment. Maybe I don't know. You could call it a Netscape moment, maybe.
Yeah.
You know, it's maybe far-fetched to call it that, but you could.
You could. I guess, yeah. No one's using it yet, so it's a little bit difficult.
Right.
But from a ideological perspective, or from maybe from a theoretical perspective, it can be, because it got everyone thinking about it, right?
100%. It's from what on earth is all of this, that 90% of the people think, you know, it's like not useful, crypto and blockchain, to thinking, you know, maybe it is, because Zuckerberg is not dumb, you know, so I mean that they acknowledge. Has
the narrative around like crypto assets like Bitcoin or Ethereum versus blockchain as a technology kind of evolved in conversations that you've been having? Have people been more interested in one than the other, and that's shifted over time?
I think it has evolved a lot. I mean, initially it was blockchain, not crypto assets. We heard that a lot. We still hear it. But I think it has evolved a lot since then. I think a lot of people understand, that have spent a minimum amount of time researching this space, that there are multiple ways to win, and that we're also in a very early phase where we don't know where the value will accrue and how it will accrue. So excluding like crypto assets altogether is just, you're shooting yourself in the foot in a way, because what if a lot of the value, or the majority of the value, or even all of the value accrues to crypto assets instead? You would have wasted your time. So I think this has evolved, yeah.
So you're finding that people are moving from the, I want to invest in blockchain technology camp, over to, I'm interested in these open source, permissionless public networks.
Taking a holistic approach.
Yeah.
That a lot are still interested with blockchain technology in general, and enterprise blockchain and things like that. There's some that think that that's the most interesting use case, but others are also seeing the open permissionless blockchains are potentially transformational and very promising, where enterprises are going to build on top. You know, everybody's going to build on top, and these are the ones that are going to power the whole blockchain system.
Yeah. So in terms of you know, what else has changed since you published that report, I'm really curious to understand, you know, the geographic breakdown of who's interested.
Yeah.
Is it mostly, you know, still the same group of people, like mostly, you know, like American institutions or European institutions?
Yeah.
Or are you seeing that change at all?
Yeah. So from what we've seen, so most people ask me and they say, you know, it's family offices, right, that are doing it. Yeah. But no, it's been a mix from the clients that we work with, it's been a mix. And it's a geographic mix too. Asia and America have been more open to adopting and making investments in the space. Europe, I don't think so. I don't have enough data points, but I don't think many European investors have been actively wanting to allocate into the space yet. So the mix is geographically spread at this time with Asia and US, and also between institutions and family offices. Quite evenly spread is kind of I have limited data points, but from what I've seen.
Got it. Okay. So any other topics that you think have changed, or any interesting questions that clients ask you that you think are worth talking about for the audience here today?
Yeah. So one of the main arguments that I hear, and I would like to ask your opinion on that actually, is we understand that this is a potentially transformational technology, but is it too early to be investing in this space? We don't see the use cases yet. That's very common. The mainstream adoption is not there. You haven't had the killer app. Bitcoin is the only one that has kind of mass use at this point, and it's just a store of value use. But when are we going to see the apps? Where are we going to see everybody using Helium? When are we going to see everybody using smart, decentralized finance, all of that? So I think that's one of the key pushbacks from folks that have done their homework. It's like, interesting, but it's too early. We'll wait and see. We can get into this at the right time and make money anyway, but we can do it when it's more de-risked.
Yep. Yeah, we hear that question a lot, right? As you might imagine. And in some aspects, the industry is very early, right? It's clearly, we don't have anything that 1 billion people are using. And there are only a limited number of products that have achieved true product market fit. I would say Bitcoin has achieved product market fit. I would say, products like Tether have achieved product market fit. I would say crypto exchanges have gotten there, and they have the users, they have revenue. And so there are a handful of examples that we can point to of, this is stuff that works today.
Yeah.
And then we can point to stuff that is a really interesting market.
Yeah.
And works either in a prototype or works at a smaller scale today.
Yeah.
But is rapidly growing, right? Like examples that we like to point to there are things like the Brave browser and the BAT token that powers their whole advertising ecosystem.
They have 8 million users. You told me that they hit 8 million users.
Yeah, they have 8 million monthly active users, something like 3 or 4 million daily actives. I can tell you, I actually was talking with my sister the other day, and she's not in crypto or finance at all. She's a doctor, and she uses Brave as her primary browser, not because I told her to, but because someone else told her, and she thought it was faster, right?
Yeah.
And we're seeing adoption of this kind of stuff where blockchain is hidden away, and no one needs to know that it's the economic engine that's powering the thing. So there is a risk of being early. But I think there's also the risk of, you miss that important part of the J curve. Yeah. And if you miss that part where it hockey sticks, one of the things about this asset class is that everything is really reflexive. Yeah. Right? These assets aren't really valued based on cash flows because many of them don't have cash flows. They're priced based on supply and demand. And so my response to a lot of those people is, you can risk being early or you can risk having to FOMO in later.
That's right.
Right? And so probably the right approach for a lot of institutions who may not have the level of conviction to go in, fully now and establish a position is to average in over time.
I completely agree, and there's another argument for doing that. The other argument for doing that is a senior partner was telling me in the allocator world, who's been around since the 70s, was telling me about the first investments in venture capital back in the day. And it was Harvard, Yale, and some of the thought leaders that took the big risks to invest in venture capital where, it was not an asset class at that point, really. And they secured capacity for decades thereafter with Sequoia, Benchmark, all these funds that have had repeatable performance and have been kind of the top decile, top quintile, top 1% of venture funds. When the next round of institutions started going into the space, that capacity had evaporated, it had been taken. And it hadn't been taken for that specific fund, it had been taken forever. So if crypto evolves in a similar fashion, and I don't know, but if it does evolve in a similar fashion, I think you want to be making your relationships with the key managers today, sooner rather than later, even if the check sizes are really small. If you think the timing might not be right, put a very small allocation in. It's also the only way that you can learn about it and keep on top of developments. And then as things de-risk and their use cases, you can start increasing your allocation. So that, in my mind, that's the most sensible way of, given all these considerations, that's the most sensible way of going about it, rather than saying, I'm not going to think about it now. I'm going to forget about it now.
I'll come back in a few years.
In a couple of years, I'll revisit, yeah.
Yeah. Awesome. Well, on that point, I wanted to open it up to the audience, which I believe has some questions for us. If you do have questions, please submit them through the Telegram chat, or we also do have some microphones that people will run to you. So
we have the first one from the Telegram chat here is for Marcos. How, as an industry, can we help you do your job and become an asset class more of your clients can invest in?
Wow, that's a very interesting question. I think that education is very important at this point. So the more you can educate institutional investors and us as well, in order to educate institutional investors in a simple way, in simple ways, not like in very complex technical ways, but in simple ways, the more adoption will come, in my opinion. So what I mean by that, I think communicate. Be open to communicating with even the allocators and people that are 1 or 2 degrees away from you. It's still a small community and everybody's learning from each other. Everybody has different roles, but everybody can help each other. An allocator can help an entrepreneur, even though we're 2 degrees away. That doesn't happen in traditional venture anymore, by the way, but here it does. So it's education. I think if you're a founder and entrepreneur, don't lose faith and keep on working hard on these problems. And as soon as their progress milestones are hit and all that, people are going to notice. I think that's the best you can do at this point.
Marcos and Tushar, thank you again for your time today and all your great insights. I thought you had great comments regarding market beta and the challenges of the VC approach. These are things that we discuss at length with our clients as well at Vision Hill Group. And what I would love to know from both of you is, as you work with potential allocators that are looking at the space, how do you advise them on portfolio construction? And particularly, you mentioned the diversification of funds, but perhaps that makes sense given the various areas of focus. But what about in the context of strategies? So what I mean by that is, how would you actually define market beta if the first step is perhaps to capture the beta? Is that going to be Bitcoin, or is that going to be an index? And then when you define that beta and you capture it, how do you look for alpha opportunities, whether in the short term or the long term?
So I can go ahead with that. So a lot of questions there, and there's a venture perspective, which is kind of a long-term approach, like a kind of a buy and hold approach, where you pick certain companies and certain protocols, and you look 10 years out. There's the hedge fund approach, where all the way to trading, where people can trade and use momentum type of strategies, mean reversion type of strategies to capture inefficiencies in the space. And then there's also investing directly in Bitcoin or investing in an index fund. I would do it, eventually I would do all of the above in this space. We have shied away from trading strategies at this point because we need more time to understand them and meet the people there. They're also not that scalable, I believe, at this point, and they're mostly Bitcoin focused because it's still a small industry and there's not much liquidity. So you can't put a lot of dollars to work, it seems to me, right now in these strategies, but they could potentially be very interesting. And especially if we see the market increasing in size on that side of the world, the trading part, and we see people from, Two Sigma and these places start going into the space, it could become even more interesting. On owning Bitcoin directly, some have done that. It's still a small group. I think it's a sensible strategy if you invest in funds, because you probably, well, it depends, but you probably won't have much exposure to Bitcoin. And if we assume a scenario in which Bitcoin becomes a major store of value, asset, and even a currency, and everything else is a flop, you're really going to regret not having had Bitcoin in there. So since you're not finding it in your funds, you might want to own it directly. The index approach, in my view, it makes a lot of sense, an index approach, because it rebalances the exposures for you, right? So you buy kind of the 10 biggest coins, and over time it rebalances it for you, and you as an investor don't need to worry about, say Bitcoin fails, right? And you're holding Bitcoin. In an index fund, this is going to be a process of averaging out of Bitcoin and averaging into the new leading crypto assets. And it's going to be done automatically for you. And in many cases, that's just easier. So I don't think there's one right approach. You need to look at each kind of fund on its own and how it's structured, custody, all of that stuff. But I do think that there are a wide range of strategies that could potentially fit into a portfolio here down the road. Right now, it's venture.
Yeah, I want to add something to that, and I actually think first point of disagreement that I have with you since we've been up here is on index funds. I don't think that index funds are really an appropriate investment in this asset class at this time. And the reason is just that the market is so inefficient that, like one, we don't even know what to index on. If it's indexed on market cap, there's so many different definitions of how do you measure the market cap of some of these assets? Do you include future inflation? Right. Do you include locked up tokens or not? Yeah. Right, and that can be very troubling. Then you have other index products out there that cap the maximum exposure to the larger assets. And so, while the crypto markets are currently somewhere between 70% Bitcoin, according to the popular website on CoinMarketCap, but actually I think much higher than that, because some of the smaller coins are very illiquid and don't actually have the market cap that they say that they do. Yeah. And so you might get too little exposure to things like Bitcoin and Ethereum due to some of these constraints that some of these indices put on there. So
we're not in disagreement about that, by the way. That the index construction is just not straightforward, and there are all these problems that you said, and different products doing it, and it's a case-by-case basis. And I do agree with you, there's room for alpha, but maybe down the road you could see an index approach make sense.
I hope that happens, because to me that would be the indication that the industry has matured, and the asset class has matured to the point where passive investing makes sense.
Yeah.
Right?
Yeah.
But here, in crypto today, I would say the only passive investment that makes sense is Bitcoin.
Okay. Yeah.
Right? Otherwise, I think you need to be actively managing.
Yeah. Yeah.
One other point that I wanted to make to your question, Dan, was just something that we've done at Multicoin is we really think that there's a real edge to participating in both the public and the private markets simultaneously with one investment team. And we think that that's an important structural edge because assets in this industry go liquid so much earlier. And so you want to be able to go and look at the public markets and see what opportunities there are for new assets to emerge from private markets. And you want to be able to go look at private markets and see what threats there are to assets that are publicly trading that might then advise your public market positions. And so we really feel that an integrated approach not only helps us make better investment decisions, but also helps us help our portfolio companies who, most people are not going to launch a chain more than once. And being able to work with a team that has worked with other people who've launched chains and gone through that process, it's not easy, can really add a lot of value.
A couple more from Telegram.
Sorry, I'm going to pop through here. Thank you.
Question for Marcos. Do you have color on how more traditional investment managers are thinking about crypto? What is stopping the firms like Citadel, T. Rowe Price, or BlackRock from participating in the market? Are they planning on entering soon?
Yeah, I think it's scale, like a Citadel and firms like that. I think they're billion-dollar shops, and to create a strategy that's crypto-oriented at this point is not scalable. It goes back to the argument I made before. Maybe you can perform a scalable, trading-oriented type of strategy with just Bitcoin potentially. So I think that's the reason. I mean, it wouldn't move the needle for them. But that said, I think that some of these shops are dabbling into it and learning about it with an eye towards the future. But scalability, most importantly, in the case of these large hedge funds, trading funds.
I think we got a question right here.
Yeah, hi. Just coming back to the issue of alpha and beta and indexing and pushing a little on your point. Granted the flaws of forming what's the appropriate market cap weight, but even someone like myself who doesn't know the space that well could say, put more than half in Bitcoin and then spread it around some others, and that's your passive investment. In thinking through, and it's interesting here, consultant view, traditional alpha, security selection, market timing, maybe pair trading, there's the fees, which will be high for funds, and it might be appropriate because of the cost of setting up the infrastructure. So a 2 and 20 model, and then on these exchanges that you guys are talking about, I'm presuming that transaction costs are high to go in and out of securities versus, say, trading, bond futures. So conceptually, but as you said, it's an inefficient market. So if you're sitting there and you're an alpha seeker, what's interesting about this market is the Citadels of the world are not in it, and so there's probably informed versus uninformed. But then, if you think about John Bogle talk about indexing, there's the tyranny of fees and transaction costs. So you are an advocate for finding an active guy. How do you reconcile, the opportunity set versus the costs, both from a fee perspective and a trading cost perspective?
That's a really good question, and fees definitely need to be considered when allocating to either an index product or to an actively managed product. I would say, one, just when you see markets that are this inefficient, that is where active managers have an opportunity to shine and actually capture some alpha. When you see markets that are more efficient, you will just have fewer opportunities, and you need to go hunting for more unique opportunities to go and make that happen. We're seeing this happen with hedge funds in the traditional equities world over the past decade, where how many value investing hedge funds have had to shut down because that strategy doesn't work in those markets that seem to be while they may not be perfectly efficient, they are more efficient than the crypto markets, right? And so I think that when you see this opportunity for capturing alpha in inefficient markets like crypto, active management does make a lot more sense. Now, you need to weigh the fees and how much alpha you think there is, right? Like what kind of carrier is the manager charging, and then how much alpha do you think they can generate? With regards to your point on transaction fees are not as high as you might imagine, and that's primarily because we do have global competition on these exchanges, and the ability to build an exchange has actually been commodified to some extent because all the payment rails are just open APIs. So if an exchange tries to raise their fees, well, a lot of the volume can move over elsewhere very quickly. And so we are seeing, extremely low fees. Now, if you're turning over your fund a bunch of times, of course you're going to end up paying a lot of transaction costs and might be tax inefficient. But that's going to be on a per manager basis and based on what their strategy is.
Transacting moves the market, right? So I'm assuming in these markets there's huge market impact relatively small.
That's why the strategies are not scalable. It goes back to what I was saying before. I think if you have a $10, $20 million fund, you wouldn't have that market impact. But if you want to play a strategy that's doing this with 200, 300, then you're going to have market impact. And if you want to make it more high frequency, it's even worse. So it's just is an issue of scalability at this point and liquidity. And what I've seen is that a lot of these trading-oriented strategies are effectively just trading Bitcoin because there's most liquidity there by far.
Yep. All right, I think we have time for one more question.
Yeah, I was just going to follow up on the earlier question. I've seen a couple of large institutions who have put kind of analysts under the radar or as a side job to look at crypto and blockchain. And I think that really helps in terms of internal education, and these institutions move very slowly. And so I just wondered, from your perspective, you obviously don't have to give names, but are you seeing that broadly, that there are people dedicated as even, as an analyst or as a side job or?
Yeah, I've been seeing it a lot. So I've been contacted by numerous institutions and our team from both within Cambridge and outside Cambridge to share notes. And in many cases, it's junior people that have been tasked to do it. But there are some cases where actually more senior people are involved. Versus a year ago, I think more senior people are involved now in terms of looking at this space. But there's definitely an increasing number of endowments and institutions taking a look. Versus like a year and a half ago, it's just huge difference.
Awesome. Well, thank you so much for joining us, Marcos. We really appreciate it. And thank you, everybody.